Traders, did your screen just give you whiplash? 1 minute you saw gold surge over 2%, pressing toward 4,634 an ounce. The next minute crude crattered more than 3%, plunging back to 4,634 an ounce. The next minute crude crattered more than 3%, plunging back to 103 a barrel. And just yesterday, gold had lost over 1% for 3 straight days, while oil had topped 2%, pushing the price all the way to 4,634. Take a look at the daily technical picture. Gold successfully defended the psychological 4,634. Take a look at the daily technical picture. Gold successfully defended the psychological 4,500 magnet and launched a powerful V-shaped rebound. The price has now recaptured its 20-day moving average. The RSI has rocketed from around 40 to above 50, signaling that the short-term selling pressure has been rapidly absorbed. On the upside, the first resistance is parked in the 4,650 zone, where the previous mid-cyclic consolidation left behind trapped sell orders. If gold can muscle through the 4,650 zone, where the previous mid-cyclic consolidation left behind trapped sell orders. If gold can muscle through the 4,670 to 4,700 area becomes the next magnet. On the downside, the 4,700 area becomes the next magnet. On the downside, the 4,545 to $4,560 zone is the line in the sand. If gold slides back inside that range, it invalidates the entire bounce and tells you the sellers are still in control. Now switch over to crude oil. WTI crude exploded over 8% yesterday, settling at 108.49 per barrel. The trigger: President Trump explicitly rejected Iran's latest negotiation proposal and declared the maritime blockade would continue unrelentingly. Reports surfaced that Iran's oil storage facilities area approaching a catastrophic blowout, and the Strait of Hormuz remains effectively sealed with Zerotimal and Euphoria opening. Button today's session arrived and crude suddenly nosed divid more than 3%. WTI tumbled from 108.49 per barrel. The trigger: President Trump explicitly rejected Iran's latest negotiation proposal and declared the maritime blockade would continue unrelentingly. Reports surfaced that Iran's oil storage facilities area approaching a catastrophic blowout and the Strait of Hormuz remains effectively sealed with Zerotimal and Euphoria opening. Button today's session arrived and crude suddenly nosed divid more than 3%. WTI tumbled from $108 to $103.60 in a sharp heartbeat. What happened? A single headline crossed the wires. A spokesman for Pakistan's foreign ministry stated that trilateral diplomatic contacts between Pakistan, Iran, and the United States are actively underway, and that all parties have put concrete negotiation frameworks on the table and are conducting internal deliberations. It was the faintest glimmer of diplomatic hope, and it was enough to trigger a violent wave of profit-taking. But here is the part you must not miss. At the exact same moment that crude was crashing on a potential de-escalation whisper, gold was screaming higher. According to normal market logic, a rumor of even marginal geopolitical relief should cause safe haven assets to retreat. Yet today gold surged while crude plunged. What does that tell you? It tells you that something else is ripping through the market, something deeper. The US dollar suffered a sudden, sharp intraday loss of confidence. The dollar index dropped over 0.6% today, hit by the triple shock of Japan's intervention warning, a deeply split Federal Reserve, and a slowdown in US GDP. When the dollar sells off, non-yielding dollar-denominated assets like gold catch a powerful bid, often independent of what is happening in the oil patch. That, right there, is the secret thread that untangles today's gold crude oil divergence, and the fundamentals continue to add fuel to this fire. The European Central Bank held rates at 2% today, but President Christine Lagarde disclosed that the Governing Council spent a very long time at this meeting debating the case for a rate hike, signaling that a June move is very much alive. The Bank of England voted 8-1 for a hawkish hold, with Governor Andrew Bailey warning that waiting for second-round inflation effects to materialize before acting would be a mistake. If both the ECB and the BOE begin tightening cycles this summer while the Fed is politically constrained by a White House transition, the dollar's prolonged rate advantage will become far less certain. Gold, in that environment, finds a new medium-term upward thrust. Oil, on the other hand, remains a pure geopolitical stress gauge. Iran's oil infrastructure is reportedly at its breaking point, yet today's news tells you that back-channel diplomacy can still produce headline shocks capable of wiping out $8 gains in 60 minutes. So the burning question, how do you forge these violent reversals and divergences into profit? Here are 6 strategies, 3 each for gold and oil, tightly risk-managed and ready to execute. Strategy 1. Beginner gold. You must confirm a signal before anything else. Wait for gold to complete a successful pullback and hold in the 4,590 to 4,590 to 4,610 region. If the price retreats from 4,634 down area and Prinsar I volume estabilization candli on a 30-minute carta lower you thengalong a placiosto plosat 4,634 down area and Prinsar I volume estabilization candli on a 30-minute carta lower you thengalong a placiosto plosat 4,550. Why there? Because 4,550 is the level Hurlus night slowser carved out. If gold lows that your bullish thesis is broken, computer tel trader riskatoni percento fiao total capital your first profit gets it at 4,550 is the level Hurlus night slowser carved out. If gold lows that your bullish thesis is broken, computer tel trader riskatoni percento fiao total capital your first profit gets it at 4,675 and your second at $4,720. Strategy 2. Intermediate gold, uses a volatility play. You can structure a risk reversal option combination. Buy an out-of-the-money call with a strike at 4,700 and simultaneous Lysalanute of the money put with Thastrikete for 700 and simultaneous Lysalanute of the money put with Thastrikete for 500. The net premium outlay should be close to zero or very small. Your fundamental judgment is that in the current risk environment, gold is highly unlikely to break below 4,500 beauty thesamianing for larger probability of staging aspects beyond 4,500 beauty thesamianing for larger probability of staging aspects beyond 4,700. If gold rips through $4,750, put you sold stays comfortably out of the money. Strategy 3. Professional gold, targets the real rate expectation stream. The US 10-year Treasury yield sits near 4.5%, while PCE inflation has hit 3.5%. If energy prices remain elevated, real yields face further compression. This sets up a long gold spot trade that you juice by systematically selling gold volatility against it, a covered call overlay that harvests monthly premium while you hold a structural long. Enter the core position between 4,600 and 4,600 and 4,620. Place a hard stop below 4,530. Your medium-term target the core position stretch esto 4,530. Your medium-term target the core position stretch esto $4,850 for 900. Monitor the 10-year yield daily. If it breaks above 4.7%, cut half the position immediately, switching to crude oil. Strategy 4. The beginner. Crude has just fallen sharply from 108 and is now hunting for a floor. A potential support zone sits in 108 and is now hunting for a floor. A potential support zone sits in 101 to 103 band. Dornatrita by Thenifasit falls. Instead, wait for WTI to pull back into the 103 band. Dornatrita by Thenifasit falls. Instead, wait for WTI to pull back into the 102.50 area and then establish a light long position. Set your stop loss at 99.80. Give Ingitramello Thep Psychological 99.80. Give Ingitramello Thep Psychological 100 handle. Your profit targets are 108 and then 108 and then 115. Position size must remain within 1%. Disruption trumps a single diplomatic headline, no matter how tempting that headline looks. Diplomatic talks can drag on for months. Oil tankers cannot wait. Strategy 5. Intermediate crude oil trader, use options to buy a true tail risk hedge. Purchase an out-of-the-money WTI call with a strike at 120 expiring in 3 weeks. The premium is elevated because crude has already staged a massive run-up. Boot you arena buying a dollar swing. You're insuring against a low probability catastrophic event. If the US-Iran standoff escalates from diplomatics heater into an actual military confrontation. If the strait is forcibly closed or anchor is struck, WTI can rip through a 120 expiring in 3 weeks. The premium is elevated because crude has already staged a massive run-up. Boot you arena buying a dollar swing. You're insuring against a low probability catastrophic event. If the US-Iran standoff escalates from diplomatics heater into an actual military confrontation. If the strait is forcibly closed or anchor is struck, WTI can rip through a 120 and test $130 with historical precedent on its side. If a real diplomatic breakthrough occurs and the blockade lifts, your loss is capped at the premium paid, which in a portfolio context is actually functioning as a hedge against your other risk assets getting hammered by an energy shock. Strategy 6. The professional cross-commodity arbitrage. Today gold and oil displayed a textbook negative correlation rift. You can trade the gold to crude oil ratio directly. Go long, risk. Enter when the gold-to-oil ratio is compressed near its recent lows. When the ratio mean reverts, meaning gold has outperformed and crude has weakened sufficiently, you close the pair for profit. Place a hard stop on the spread if the ratio moves another 5% against you. And now, before you put on any of these positions, I need to hammer the risk warning. First, Pakistan's initial diplomatic soundings may well be proven empty, but their very existence means that back-channel negotiation is active. If you are running a naked, unhedged long oil position, a single-piece rumor can obliterate your entire open profit in under an hour. Second, gold's dramatic bounce today does not erase the fact that it was cascading lower for 3 days. If gold fails to hold $4,500 again over the next few sessions, the institutional unwinding that Goldman flagged may not be fully purged yet. The final flush of a trend reversal is often the most violent. Third, the dollar weakened today, but if incoming Fed Chair Kevin Warsh makes even a single remark that exceeds market hawkish expectations, the dollar can snap back with a vengeance, hitting both gold and crude simultaneously. Here is today's bottom line on gold and crude oil. Geopolitics and the US dollar are ripping on the same frequency and tearing these two assets apart. Gold is being reborn from the ashes of the 3-day sell-off, while crude oil is being whipped back and forth. Negotiation. The profit is not in picking one direction. The profit is in trading the fracture between them. Type into the comment section the key gold level you are watching right now. Is it 4,634 today shy author looming 4,634 today shy author looming 4,670 resistance? Let's turn the comment section into a live trading floor. If this breakdown gave you clarity inside the chaos, smash the like button. Subscribe and hit the notification bell.